Good morning, everyone. Thank you, Ketan Bhai, for giving me opportunity to share my views on uh, the important topic on scale-based regulation, which is applicable for the NBFCs. So before we start, or maybe this is a table of content. So next 1 hour we'll be discussing more around this thing. Don't worry, there are 16 topics, but each topic is only one slide. So rather than discussing more theoretically, it will be good if we have a two-way discussion. If you have any insights to share, since you all are, I assume you all are into NBFC's bank audits. Uh, so it will be good if you can also share your views, your insights, your practical experience, which will be helpful to others. Before we start, just want to know anyone who is directly, indirectly linked to banks or NBFCs, either auditing or working with banks, NBFCs. Great. I think most of them are involved directly or indirectly with banks or NBFCs. So most of the stuffs here when we talk about scale-based regulation is nothing but RBI is trying to bring some of the NBFCs in line with banks. So basically, till now, if we see 2026 regulation master direction, the classification which was been done for NBFCs, it was very narrow, the binary definition, which means that the smallest or the biggest NBFC, there were not much difference when the regulation or the oversight of the regulator comes into picture. And hence there was a need of scale-based regulation. So to start with, if someone can help me in understanding what is an NBFC, and we don't want any technical or any theory answer, something which in practical life we all understand what is an NBFC. Yeah. Anyone? Think this is the slide, the definition. This is as per RBI, but what according to you, simple, what is an NBFC? Okay. So we want a one-way communication, or yes, please. Yeah, perfect. So basically NBFCs are financial institutions which predominantly act or work like a bank but is not a bank. So they are into the business of lending, they are into the business of investing. However, they are not exactly what bank does. There is a difference between a bank and an NBFC. How will you identify an NBFC, or what are the criteria which are required to be for identifying an NBFC? So here principle 50-50, everything is written, you can read. However, what is the need here? Hello. Yeah. So there is a principle of 50-50 test which helps us in understanding whether an entity is a NBFC or not an NBFC. Now what is this 50-50 test? Basically your asset and your income. So the income and asset, if it is more than, if your total financial asset and financial income is 50% or more to your total income and total asset, that company has been classified as an NBFC. कारो रिपोर्टिंग ऑडिट करते हो, कारो रिपोर्टिंग हम लोग सब देते हैं. ये टेस्ट हम सारी एंटिटीज के लिए करते हैं, इवन इफ इट इज अ मैन्युफैक्चरिंग, सर्विस इंडस्ट्री, ट्रेडिंग इंडस्ट्री. So basically RBI says that whenever an entity is into a business of financial activity, that means they are into a lending, investing, leasing activity, those entities will classify as an NBFC and will be regulated by RBI. However, it is not necessary that all the entities will fall under this definition. A manufacturing or a trading company may on a temporary basis invest or lend. Whether they will be classified as an NBFC? The answer is no, because they will not sustain or be eligible under the 50-50 criteria, and hence those entities will not be classified or considered under an NBFC norms. uh, what what is the role of NBFC in financial inclusion? Why there is a need of a NBFC? Because we have a bank. Bank also does the same activity. In fact, bank does much more activity or are allowed to do much more activity as compared to any NBFCs. Then why we need NBFCs, or what is the need of an NBFC? Yeah. So those are required to be deemed NBFC, and then the requirement is you need to obtain a registration. If it is only temporary in nature, in that case you need to write, as an auditor you are required to give an exceptional reporting stating that this entity is this, however this is of temporary nature, subsequently it is not, and entity which is willing to work or do a business in financial activity. And even from a company side, there is a reporting which goes to a RBI stating that it is there is no intention of carrying out any financial activity. It is temporary in nature, because of which the investment or the financial asset, and the requirement is end. Both the financial asset as well as financial income from those assets should be more than 50%. If it is either or, they are not satisfying the needs. Yes, sir. Then as an auditor you are required to do a exception reporting, and then so temporary is basically based on the nature the company is willing to do, the nature of business they want to do. So to take an example, newly set up company who has a capital coming in, and that's the reason for the financial asset definition as well, the amount in the bank and the fixed deposits are excluded from that. If you see, cash and bank fixed deposits are considered as a financial asset, but for the definition, for the purpose of testing this 50-50 criteria, you are not required to include the fixed deposits and the income which you have earned on those fixed deposits. So that is an exclusion which is given. And to answer your question, to take an example, a newly company who has got the funds and for temporary purpose they had deployed that fund in mutual fund. There is no business which has been started. So based on the last audited financials, you are coming that the financial asset and income is more than 50%. But the idea is to do the trading services, and subsequently they have started that business that is temporary in nature. Yes, sir.
Hi. See, I have one query. Like one HNI, he wants to use his personal wealth and he wants to invest money. Okay, and there is no customer interface, and he's not taking any money from the banking channel also. And the amount is more than 10 CR and all. So still he will need to have an NBFC license because he's primarily doing investment activity.
So he want to
do an investment activity through a company.
Through a company, then yes. So NBFC definition is basically a company which is registered under the act and doing this activity. Then yes, if investing activity is there, it will be classified.
But it's only his personal wealth. Then also he used to do it.
Yes. Doesn't matter.
Any specific reason for this? Like
so that you will come across that there are various layers which has been defined under which why it will set up. The regulation around that entity will be much lesser as compared to any other layer, because this is the public deposit is not involved, the public interface is not involved, and hence it will be classified in the base layer but as a NBFC, where the requirement is so the definition also includes that investing activity is classified under NBFC.
Okay, thank you.
Yes, sir. They are regulated by, okay, so since you asked this question, whether all the financial institutions are regulated by RBI and been considered as an NBFC, so the answer is no. So any entity which has been regulated by any other regulator, like mutual fund by SEBI, merchant banker by SEBI, insurance by IRDA, those all will be considered as a financial institution but not as a NBFC, and will not be regulated by RBI. Yes, no, that will not be excluded. Only FDs. Okay, sorry, I took your question wrong. However, there is an FAQ which talks about whether all the financial institution will be considered on the under the purview of RBI. Answer is no. If someone is been regulated by another regulator like SEBI, IRDA, then those are excluded from the purview of NBFC.
Yeah.
Yeah. So
Can I ask this question this side?
yes, please.
Okay, this assessment of this 50-50 criteria should be done on the basis of latest available audited financial or
Last
as on
audited
date?
financials.
Last audited. So if I have to report on 25 financials, I have to see 24 balance
24.
sheet?
Yeah.
And so
24, but since you are closing on 25,
Huh.
and when this criteria has been breached,
Exactly, that's where
so
I was
there
coming to
is a-
Caro
yeah,
reporting.
so there in Caro, you will mention the fact. However, also you'll do an exception reporting stating that these are the temporary phenomenon in nature to RBI.
No, it may not be temporary, it may be a genuine and 50-50 criteria.
So
but
then there is a
but-
timeline
huh.
that once as at 25, when you close that, there is a timeline that you have 2 months of time to apply for a registration.
Okay, so that
You
fact
need to
needs to
mention
be
that fact in
mentioned in the Caro in that case, because the assessment will, once 50-50 is meant, you will come to know only when the balance sheet is drawn,
Yes,
correct?
Yes. Yes.
Okay, understood, thank you.
So what are the key differences between bank and NBFC? Or we were discussing about role of why an NBFC is required in India, even if we have a banks who. So that is the key difference. First, why NBFCs are required. Right. So basically extending the facilities to a underserved categories or a sector like small businesses, vehicle kind of loans, or to a very small microfinance kind of loan. So that is one thing that okay, they extend to a great section where, and it fills the gap between the where the banks are not able to reach. Okay. So they are not only into this business. NBFCs are also doing very niche business like infrastructure funding, microfinance, housing finance. We have large HFCs, housing finance companies in India which get classified under the upper layer. So they don't only support the underserved category, but are also into the niche category, which helps in supporting the financial support to the country.
Yeah.
Now coming to the differences, what are key differentiator? One, you mentioned that okay, as an NBFC you cannot open a demand account in an NBFC. So the NBFC cannot issue a checkbook to you. You can draw and withdraw the money. The only available source of fund is term deposits, public deposit in the nature of fixed deposit kind of stuff, and hence that's the reason there is a need of scale-based regulation, because earlier public deposit were having some additional stuffs, additional regulation. However, based on the size, there was not much difference between a smaller NBFC or a larger NBFC. The NBFCs are not part of the payment and settlement network. So as I mentioned, since you cannot write a check and ask, because they are not a clearing house. So this is the biggest difference. This also shows that the importance of a bank as far as the payment and settlement, a part of a payment and settlement network is concerned. Unlike bank have a deposit insurance. So your funds are insured up to the extent of 5 lakh when it is with bank. However, for NBFCs, even if you are putting kind of public deposit, it is not insured. And again, that is the reason there is a need that there should be focused regulation around those entities which are public deposit, and hence there are few entities which are allowed to take the public deposits. So NBFCs, there is a flexibility when it comes to lending. However, there are restrictions on other parts, and hence the only source of fund which is available to them is banks, borrowing through bonds, or to some extent public deposits, unlike bank who have the cheaper source of fund, that is saving and current accounts. So that is the major reason, the difference between a bank and a NBFC. So need or a trigger for regulatory framework, why there is a need of, so before we go to the need, anyone who understands, who does the audit of a NBFC or who is a part of NBFC? What was the earlier regulation? How the classification was been done for the NBFCs? Right. So basically it was based on the asset size and deposit acceptance. So a non-deposit NBFC having asset size of less than 500 crore was been classified as a non-systemic important NBFC. And similarly, non-deposit taking NBFC with asset side of more than 500 crore is a systemic important NBFC. And there was a there was public deposit acceptance NBFC. So if we see this definition, this was purely based on the asset size and to some extent public deposit. So the company NBFC with 600 crore balance sheet size and a NBFC with 10,000 crore balance sheet size, both non-public deposit entity would have similar kind of regulations. So the regulation, the RBI way of doing the audits or the regulation around those were similar. And that's the reason there was a need that we need a principle of proportionality. That means the bigger the size, the bigger or the stricter the regulation will be applied to those entities, which is the reason there is a scale-based regulation which came into picture. So post 2018, when we saw some ILNFS related matters or so, the NBFCs have expanded exponentially. The size of some of the NBFCs are bigger than the banks. And since it is bigger, they don't have the limited source of fund. They are mainly dependent on the banks, mutual funds for source of funds. So anything or any risk on those is a systemic risk on the overall financial sector. And hence, this is again one of the important reasons why we need a scale-based regulation. Regulatory arbitrage. So as I mentioned, there are some NBFCs which are larger in size. However, the regulation which was applicable to them were very light as compared to some of the smallest banks like foreign banks or a public sector or private sector bank, which are less in compared to size as compared to any of other NBFCs. So that is again one of the important reasons the regulatory arbitrage which triggered the requirement of SBR. So proportionality we discussed, the bigger the size, the stricter the regulation, and hence SBR came into picture. SBR framework and introduction. So in Jain 2021, the draft of SBR framework was made available for public to comment upon. October 2021, this came into picture. The framework was released, mentioning that it will be applicable from 1st of October 2022. Since then, the SBR is into play, and in October 2023, the consolidation of most of the circulars around this SBR got consolidated. The latest update is on May 2025. So scale-based regulation is a comprehensive framework. It works based on a pyramid structure. There are four layered structure, which is base layer, middle layer, upper layer, top layer. We'll have a detailed discussion around each layer. Base layer is kind of a basic regulation which will be done around those layers. Middle layer is an enhanced norm. Here most of the NBFCs sits where the asset side is more than 1,000 crores. Upper layer, again some of the top NBFCs and some of the NBFCs which are being identified by the RBI based on the scoring methodology, and basis this, the upper layer has been identified. Top layer by design, it is an empty bucket. So as of now, there are no NBFCs which are placed under top layer. However, why there is a need of a top layer, we have a detailed slide on the same. So moving on, so as we discussed, there are 4 layers: base layer, middle layer, upper layer, and top layer. So a non-deposit NBFC with an asset side of 1,000 crore and less, are being classified under the base layer. There are other entities as well. So for each layer, we have a detailed slide. So here only we'll just understand what are the type of layers. So most of the NBFCs sits under the base layer. Ketan bhai also mentioned there are number of NBFCs which are there in India. Most of the NBFCs with asset side less than 1,000 crores sits here. By number they may be large, but by riskiness, by the perceivedness of their risky nature, it is less risky as compared to any other NBFCs. Then there is a middle layer where a public deposit NBFC or an NBFC non-public deposit, but the asset side is more than 1,000 crore is been classified under the middle layer. Upper layer, as we discussed, it is purely based on the size. First 10 NBFCs will get classified under the upper layer, and some other entities based on the scorecard mentioned by RBI and based on their assessment, they classify. As at date, I think there are some 25 entities which sits under upper layer. Upper layer. Top layer by nature, as mentioned, it is nil as at date. So as we move up, the RBI regulation or the assessment or the review of RBI becomes more stricter as we move up the layer. Okay, so getting more into details with respect to the base layer. So base layer is a non-deposit taking NBFC with asset side of below 1,000 crore. There are specific NBFCs which are being classified under this, which will, irrespective of size, will be classified under the base layer. So one is peer-to-peer lending platform like fintechs, which basically doesn't give the loan but only bring the leads for the NBFCs who lend. So they will always be classified under this category. Account aggregators, which are basically aggregation of the data of a borrower, who again just help the lending institution to do the assessment of a borrower, to collect the data, hand it over to the lender. However, they don't directly do the lending. So the account aggregators also get classified here. Non-operating financial holding companies. So financial holding, non-operating means companies who are investing in the shares of a bank or an NBFC or any other financial institutions, but again are not directly involved in the lending activity. And NBFCs where there is no direct customer interface are also been classified under this entity. So what are the regulatory requirements? So in earlier regime, the net owned fund requirement was 2 crores. Now all the, irrespective of the layers, they are required to bring the net owned fund to 10 crores. And the timeline given is up to March 2027. So basically 2 crore to 7 crore and 7 crore to 10 crores. So this is now the requirement, and any new NBFC coming in applying for a registration, they are mandatorily required to have a net owned fund of 10 crores. So 2 crore, a gradual increase is only for the existing NBFC. For any new NBFC, they are required to have 10 crore as a minimum net owned funds. Capital requirement, again, there is no change as far as the middle layer or a base layer is concerned. 15% was always there, it is still there. For upper layer, there is a change. It is more in line with banking. We'll discuss more in detail when it comes to next slide. NPA recognition or a transition to 90 days norms. So in earlier regime as well, whenever the entity was a non-banking entity, non-public deposit acceptance entity, which with a size of less than 500 crore, the norms applicable to them was 180 days criteria to tag any account as an NPA, which was again gradually bringing to 90 days. Here for base layer, in this year, current financial year 25-26, the applicable norm is they will now require to come to 90 days. Earlier till last year it was 120 days, before that it was 150 days. So gradually they are bringing this norm in line with any other NBFC, which is 90 days norms. So basically any account which will default and is not making a payment for 90 days of interest or principal or both will be classified as an NPA based on 90-day norms. So this transition is something which is impacting the base layer, because you will get an elevated NPAs in the transition period. Earlier you were not classifying an account with 100 days DPD as an NPA, but now in this financial year, you will be classifying those accounts as an NPA. So if you are doing an audit, which is a base layer, sitting in base layer category, this is one important thing which you are required to assess for this financial year. Here the standard asset provisioning is again applicable till last year. March 25 was 0.25%. For March 26, it is 0.4%. So standard asset provisioning when we do on the standard book, it is 0.4% applicable to all entities. And again, in line with banks has some categorization, different categorization. Here also, base layer is till last year, March 25, they were doing 0.25%. However, now going forward, they are required to do 0.4%. Some additional requirement, they should have the asset liability management policies, the board policy for loans to directors and senior officers, internal guidelines on corporate governance, fair practice codes, IT security, but at a basic framework. So for upper layer as well as for middle layer, the requirement are much stricter and much more as compared to the base layer. Sorry? No. So basic base, the kind of audit committee, even if it is applicable as per the Companies Act requirement also. So RMC, your IT steering committee, all the applicability comes to the upper layer. In fact, only difference between the middle layer and the upper layer is the IT steering committee, where upper layer is also required to have IT steering committee. But this is less than this thing. So you as an auditor are required to again, so that there is a separate certification which goes, which is addressed to the board of directors on the criteria, eligibility criteria which has been fulfilled by the NBFC. You need to qualify there. And again, as an exception reporting, you need to mention to the, give to the RBI. So there you give whether the net owned fund is been satisfied, whether they are actually doing the business which is for which they have obtained the license, what is the license number under which they are doing this business. So there are certain criteria, certification which you as an auditor does, you need to qualify there. So now without that RBI is not going to give you the license. Yes. Sorry? No. 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 So CET and everything, there is a definition. So if you have got the subordinate debt, just a second, sir. If you got a subordinate debt, there is a definition of subordinate debt which gets classified as a tier 2 capital. But loan coming directly, which, so if that satisfied certain criteria of subordinate debt, then yes, otherwise no. In net owned funds, so the base layer will be mostly in Indian GAAP. So for base layer, you will always be have either cost, you will be using the accounting standards and not Ind AS. So it will be cost, or you will be mainly on the historical cost book. So you will consider that. Ind AS, it will be at fair value. However, certain unrealized gain which is there, you need to remove that from your reserves. So net owned fund has a definition which takes that you need to consider everything. However, certain unrealized gain which is sitting there, you need to reduce that. While calculating financial asset? No. No. If not met, then there is an exception reporting. Yes. You need to do no, so for existing, if you are going, you need to give, you need to have a net owned fund of 10. Otherwise, you are not going to get a license at the first place itself. On a going concern basis, if there is an erosion in the net worth, then a reporting which is required to be done. So the requirement is you need to, on ongoing basis, you need to have a net worth of 10 crores. So if there is an erosion in there, you are required to do a reporting with respect to that. That there is an erosion, there is a separate certification which goes for this. So you will mention the fact that the net worth is been eroded with respect to this. You need to mention that fact. In Caro is nothing but a matter of fact which is required to be reported. So whatever is the amount, whatever is the computation comes, you need to report that. And along with that, there is a separate certificate also which goes to the director. There also you need to mention that. Yeah, criteria for middle layer. So all deposit taking NBFCs, irrespective of size, which sit under middle layer. Non-deposit taking NBFCs with asset size of more than 1,000 crore will also come here. There are certain NBFCs like housing finance, core investment companies, infrastructure finance companies, standalone primary dealers, which will be classified under this category. Government NBFCs will be placed either in base layer or middle layer. Even if the size exceeds, it will not go under the upper layer till the time there is a specific clarification or a further communication from RBI. So government NBFCs are being kept out of the upper layer entities. Again, the regulatory requirement here again remains same. The 15% is the minimum with tier 1 capital of 10%. Then there is a new requirement of ICAP, internal capital adequacy assessment process. Now this is new subject for NBFCs. However, it was always there for banks, where they do their internal assessment about the capital requirement in the stress scenarios. So basically it is not only about the minimum requirement, capital requirement. However, if they consider their liquidity risk, market risk, credit risk, where they stand, what is the actual requirement or what is the actual capital requirement, irrespective of 15% which is there. So they do certain stress testing. So as an auditor, we generally do not opine or do the audit of this document. However, we should review this document because this will help us in understanding how the management perceives the risk about that particular entity. And for sure, RBI reviews this and also give the comments. If you have read the RBI inspection report, they definitely give the comment about this ICAP in their document. So as an auditor, yes, we are not required to opine, but definitely we should review to assess how management looks at the business, what are the stress scenario testing they have done, and as a entity, from a solvency perspective, where they stand. NPA classification, there is no change. 90 days criteria, earlier also it was applicable, now also it is applicable, so it remains same. Exposure limit, there is a change. Earlier the exposure limit was basically based on 15% of their net worth or the net owned fund. Now it has been revised to single borrower exposure capped at 25% of tier 1 capital and 40% of tier 1 capital when it comes to the group exposure. Governance, as we shared, here you will need to have audit, risk management, NRC kind of committees. LCR for the NBFCs, where earlier the requirement of LCR was NBFC with asset size of more than 10,000 crores, they are required to maintain the LCR. However, I think since December 2024, the entities with more than 5,000 crore size are required to maintain LCR, and now the LCR requirement is 100%. So again, there is a detailed formula, HQLA, what is my liquid asset, what is my liabilities, which will be assessed for next 30 days. Basis that you need to assess what is the LCR for that particular entity. And now the requirement is the NBFCs are required to have 100% NBFC on ongoing basis, LCR. Right. So basically, key thresholds are where the size is more than 1,000 crore will sit under this particular category. Any NBFC which accepts deposit will sit under this category. And specialized NBFCs like HFCs, infrastructure, CICs, PDs will also sit under this particular category. Next is upper layer. So these are the NBFCs identified by the RBI based on the size, nature of business they are doing, and the risk which they carries. So by definition, inclusion is top 10 NBFCs will sit under this category. And basis the assessment which has been done by the RBI team, they will identify certain NBFCs which again will be called out, will be classified under this particular category. As at date, there are 15 such NBFCs. I think there are some 5 housing finance companies and 10 some other investment companies as well as other lending institutions. So how RBI also identifies this based on the scoring methodology. There is one detailed annexure which has been given, again considering what are the nature of business they are doing, where they are further lending, what is the riskiness in the business what they are carrying out, and basis that there is a scoring methodology which has been defined. And when the RBI does the assessment, they does the assessment of the scoring as well, and basis that they either classify that under the upper layer or declassify them from the upper layer if they are already into that. Currently, as we discussed, yeah. So here, again, the overall capital requirement is 15%. However, there is a difference between what was applicable to the base layer and what was applicable to the middle layer. Here, there is a concept which comes in which talks about common equity tier 1 capital. It is new again for the NBFCs. However, for the banks, it was always there. It is there since long. Common equity tier 1 capital is nothing but your equity plus your reserves and surplus, excluding certain goodwill and intangibles kind of stuffs. So pure capital, and why and the requirement is the NBFC should have minimum 9% out of the overall requirement of 15% as a common equity. So why there is a need of such common equity tier 1 capital requirement? Yes, sir, please. Okay. Anyone else wants to try? Sorry? Yeah. Yeah, so it's coming from Basel now, but why there is a differentiator between why you need a common equity tier 1 capital? So it's rightly maintained, is purely based on the riskiness. So the idea is that you should not be more dependent on tier 2 capital like subordinate debt, external borrowings, or by creating the provisions, right? Having the general provisions around. So the idea is that to observe your loss, you should be well within your capital requirement by your own funds rather than relying more on the outside funds. And that's the reason the common equity tier 1 capital came into picture, which is applicable to the bank. However, now been introduced to the upper layer of NBFCs. Large exposure framework limit, again 20 to 25% limit of tier 1 capital. Here, again, the standard asset provisioning requirement is more like a bank. It ranges from 0.25% to 2%. So MSME loans, 0.25%. Any question around why we need this standard asset provision? Because अब तक तो सबको ये चमक गया होगा कि भाई टॉप लेयर, अपर लेयर, मिडल लेयर 1000 करोड़ के ऊपर तो सब इंडेक्स में होंगे, तो ECL आएगा. तो why this provisioning, standard asset provisioning? Because there is a floor requirement of RBI that even if you are doing an ECL provisioning, however, the minimum requirement should be what is expected or what has been based on the IRAC norms. So for NPAs, for standard asset, they have decided or given certain provisioning rates basis which you need to compute your provision as per IRAC and provision as per ECL. So here for NBFCs which are under base layer or which are under middle layer have 0.4% direct on your standard book. Here it is not that simple. First you need to identify which all categories it sits into. So SME it will be 0.25%. For commercial real estate which are into residential thing will be 0.75%. For other commercial real estate it will be 1%. For other things it will be 0.4%. For teaser kind of loan where I am giving initially low interest rate, but going forward the interest rate will increase. In such cases you need to apply 2%. So again, basis the size, they are treating this kind of NBFC equivalent to a bank, and accordingly the provisions which were applicable to the banks are been also imposed on the NBFCs. So from structural perspective, they had been treated more like a bank. However, there are certain restrictions, like they cannot do certain activities which are allowed to the banks. So core financial services, basically on technology side as well, the expectation is that the like core banking solution, all your branches should be integrated to one system. So for upper layer, the requirement is March 2025. So this is not in the guidelines. However, in 2022, there was a notification which talks about this, that for upper layer till 2025, all the branches should be integrated through one core banking solution. And for middle layer, wherever the branches are more than 20, they have time up to March 2026. ICAP requirement, again same what we discussed for middle layer, is applicable here as well. So basically, notable features are there are 15 NBFCs under this particular category. The supervision intensity is similar to kind of a commercial bank. There is a demotion which is possible provided a NBFC is reducing its size and its risk for a consecutive period of 4 years. Then RBI may decide to bring that back to the middle layer. Government-owned NBFC, as we discussed, will not form under this category, provided RBI specifically add that in this particular list. Top layer, so as we mentioned, it is empty by design. So there are no NBFCs which are currently there. Basis the again size, nature, riskiness, systemic risk if is been identified by RBI, the RBI can classify this under this category. Till date there are no such, and we hope आगे भी नहीं आए, क्योंकि अगर आ रहा है मतलब उसमें कुछ प्रॉब्लम है जिसको RBI काफ़ी क्लोजली मॉनिटर कर रही है. So till the time there are no NBFCs in this, I think it is good. So this is just an overview between old versus new regulatory framework. Just run through fast because we have already discussed on this. Two-tier approach earlier, non-deposit, non-systematically important, and non-deposit systematically important. Now there are 4 layers: base layer, middle layer, upper layer, and top layer. Minimum capital requirement was 2 crores. Now it is coming to 10 crores in a gradual way. NPA classification remains same for everyone except for base layer, when 90 days norm will get applied from this financial year. 25-26. Yes. Yes. So this financial year, it is means this financial year. And it's every single day. Yes. So it is applicable from this financial year, 1st April 2025. So prudential norms for large NBFCs. So limited differentiation between large and very large NBFCs. There was no CET1 requirement. It was always a overall 15% CRAR requirement. However, for the upper layer, there is now a CET minimum requirement of 9%. There is a leverage cap which will be prescribed. There is a ICAP which is required, assessment which is required for middle and upper layer, and large exposure framework limits for any NBFC more than 5,000 crores. They are required to have on going basis 100% LCR ratio. Yes, sir. Not necessary. सर आप थोड़ी वेट करोगे कि आदमी उधर पहुंचेगा तो ही मरना चाहिए, जब आदमी ने कुछ किया है तो. यस सर. यस. यस. So top layer, if you see, it is more, so you are right, prompt corrective action which has been initiated on some of the banks as well. So maybe any of the entity where the RBI perceive that it is risk, and the risk is not only particular to that entity, is a systemic risk which can impact the overall financial institutions like ILNFS which happened, or DHFL which happened. Such kind of scenarios should not come again. So as a proactive measure, they will classify this under top layer, and they will ask the NBFC to stop doing further lending. So these kind of actions are also been taken now. Not necessary it has been only taken when it comes into the top layer. However, whenever there is a systemic risk which will come into picture, for sure the activities like further lending or recovery, all those stuffs will come into picture. Governance and disclosure already discussed. One notable change is IPO financing. So earlier there was no limit. Now there is a limit that for IPO financing, it can be only given up to 1 crore. Related party, for any loan which is required to be given to a related party, director or a relative, there is a limit of 5 crores which should be approved by the board of directors. Yes. No, preference share is part of tier 1 as well. If it is compulsory convertible, it will part of tier 1. Optionally, the portion which is part of your equity, that will get classified under tier 1. Tier 1. Technology we discuss, LCR we discuss. We will not spend much more time on this. This is again just an overview. So CRAR requirement is 15%, minimum of 10% in tier 1 for middle layer and base layer. For upper layer, it is CET requirement of 9%, and top layer, it will be determined by the RBI. Minimum net own fund 10 crore by 2027. ICAP is not required for the base layer. For all other entities, it is required. NPA classification, again, it is now same for every entity. Standard asset provision, again, same for all the entities except for upper layer. Upper layer is based on 0.25 to 2% based on the category. ECL and IRAC norms, we'll discuss this in detail subsequently. However, all the entities which are under Ind AS are also required to check what is the provisioning requirement as per RBI, and accordingly need to do the accounting or create a reserve if there is a shortfall. Single borrower limit is based on the existing norms. For base layer, that is 15% of your net owned funds. For middle layer, it is 25% of tier 1 capital and 40% for group borrower limit. 20% for tier 1 capital for upper, which can be extended up to 25% with board approval, and similarly 25% of tier 1 capital for group as well, and for infrastructure it is 35%. So this is all what we have already discussed in detail. Only one thing what we have not discussed there is the compensation policy. So earlier there were no regulatory guidelines or any bar that how much variable pay you can make to a material risk taker kind of people in the entity. Now for middle layer, it is required that you need to have a proper compensation policy defining what percentage of your fixed portion can be given as a variable pay. For upper layer, there is further requirement that you should also have a clause of deferral payment. You should also have a clause of drawback. So in case if certain criteria are not been met, or certain things goes wrong on behalf of certain particular thing, you have a right again to draw back that. So as an auditor, we are required to now review this policy as well, that okay, if the variable pay has been given to any material risk taker like CFO, CEO, whether this all policies have been put in place and whether the payment has been made accordingly. If there is a deferral payment system, you cannot make a payment upfront. So you need to have, as an auditor, we are required to review these policies. So this is the only thing what we have not discussed in any of the earlier slides. Yeah. So before we go to the NPA norms, I think I have another 10-15 minutes. We'll try to. So NPA norms, again, there is no difference. Anyone who is doing bank audit here or doing NBFC audit? So I think the norms are more or less same as compared to banks, but I think since most of them are not doing the audit, so to start with the basic, anyone who can define what is an NPA, non-performing advance or non-performing asset. So any default done in common parlance, any default which has been done by a borrower, either in making a payment of principal or interest or both, for more than 90 days, is being classified as an NPA. Right? What are various categories of NPAs? So this is the only side on NPA in this whole presentation. So not necessarily we'll discuss only this thing. So let's have some detailed understanding or a conversation on this. What are the various kind of NPAs? What are the stages? And what is the need of those stages? No, those are not NPAs category. Substandard doubtful loss, right? What is the need of those categories? Why not single category? Shown the quality, the collaterals, the provisioning requirement. So RBI, based on the rules, they have defined that if you're sitting under which category, what percentage will apply, because they can perceive that, okay, it is still an NPA, but not that risky. However, when it comes to a doubtful stage, the collateral again come into picture. The collateral which is given to you, the security which is given to you, whether you will be able to recover out of those security. If no, then you are required to make 100% on those unsecured amount. If yes, then there are certain percentage which has been prescribed. So based on the NPA criteria, based on first the default, you are being classified, or the borrower has been classified as an NPA. Based on the classification, there are various categories: substandard, doubtful, again in doubtful, doubtful 1, doubtful 2, doubtful 3, then loss. It is not necessary that one will wait for 4 years, 5 years for accounts to get classified as a loss. If there is any inherent weakness which has been identified, if there is any, if the risk is more as compared to any other criteria, it is required to be classified those account directly to the loss asset, rather than waiting that for first year it will be in substandard, for next 1 year again it will doubtful, for 2 years in doubtful 2. You can classify directly this account under loss category. This special mention account reporting is again a new, so NBFCs were doing it, but that was only for the internal purpose. So basically SMA reporting is nothing but you identify the categories based on the DPDs. So if the default is up to 30 days, it will be under SMA 0 category. If the default is from 31 to 60 days, it will be classified under SMA 1. And up to 89 or 90 days, it will be classified under SMA 3. What is the change? So base still it remains same. It is an internal assessment. It just help to identify the stress in the asset upfront, or a proactive approach to identify any asset will be turning, or a kind of probable NPA kind of case. However, in case of upper layer or middle layer, wherever there is an exposure of more than 5 crores, now they are required to do this reporting. So this, no. So there is no provisional requirement for SMAs. However, in ECL, when you come, it automatically takes care because of the staging. So there is no additional provisioning requirement which has been asked by RBI to create on this. So now the requirement is for cases where there are more than 5, where the exposure is more than 5 crores, this reporting is required to be done to RBI, the way it has been done by banks. Enhanced provisioning requirement, I think we have already discussed this. This is applicable for the upper layer category. Now, how will you upgrade this account? Once the account becomes an NPA, how will you upgrade those? Viraj bhai, how much? How much? Okay, fine. So in 2021, so before 2021, there was varied practice which was been followed by NBFCs. So an account which is turning or which is in default for more than 90 days were been classified as an NPA. However, whenever the DPD used to come below 90 days, the NBFC used to upgrade this thing to bring the uniformity across all the NBFCs and to bring them in line with banks. The RBI in 2021 came with a circular which says that you can upgrade the account only in case all the overdues are being received, and it has to be at the borrower level. To take an example, if a borrower has single facility, defaulted, 90, has not paid 3 EMI, will become an NPA. However, he has paid one EMI and now the DPD is only 80-85 days. Whether this account can be upgraded? Earlier regime, yes, NBFCs were doing this. However, now there is a clear guidance that it can be upgraded only when the DPD at the borrower level, not only at the facility level. All the facility which has been enjoyed by the borrower needs to be have the zero overdue, and then only you can upgrade that. So that is one important change which came since 2021 for the NBFCs. So SMA is purely based on DPDs, they are not NPAs. So if the default date is up to 30 days, it will sit in the bucket of SMA 0. If the DPDs are up to 60 days, it will sit in the bucket of SMA 1, and up to 90 days in. So post 90 days, it becomes substandard. Then for 1 year, it sits within the category of substandard, then doubtful for certain years under doubtful category, then loss. So this is a separate topic to discuss. So if you go by IBI definition, it's a confusion which has been created, but basically if you see most of the banks and NBFCs doesn't consider penal charges or bounce charges to classify any account as an NPA or to upgrade those accounts. But still there are lots of debates, discussion which goes on with the RBI team as well. Because now the accounting has been done basically mainly on the realization basis and not on accrual basis. The justification which has been given by a bank or an NBFC that since the accounting is not been done and these are penalty kind in nature and not income generating source, penal charges or bounce charges are not income generating source for me. It's just a penalty to bring discipline in the customer and hence should not be considered as a part of NBA while classifying or while upgrading. This is now been followed across NBFCs and banks. ECL, yeah. So again, so the NBFCs which are under ECL, they follow this model 109. It has been driven by Ind AS 109. And what was the need? So after 2008 financial crisis, I think everyone realized that the provision which has been created by the banks based on the incurred loss model means we will wait till the time the loss is incurred, and we will create the provision based on the rule given by RBI or across the globe by their regulators. Everyone realized that the provision which was being made was too late and too little. Why little? Because it is again based on the percentage metrics given by regulators. And then the ECL or the expected credit loss stuffs came 5 minutes, came into picture, where at the time of origination, on day one, you envisage what is the risk I'm going to get in this particular entity or to this particular borrower in next 12 months, which will sit in stage 1, or a lifetime stage 2 or stage 3. And accordingly, you design your probability of default for each particular stage, your loss given default, and your exposure at default. Sorry, I'm rushing because of the limitation of time, but we'll only focus on something important, which is probability of default or LGD. So probability of default is basically very simple. If you are giving 100 rupees loan, out of that 10 rupee loan is going bad, so basically probability of default is 10%. Loss given default is you have a security, out of that loan which got bad, you are able to recover 60%. So your loss given default is 40%. So what you are not able to recover is loss given default. And exposure at default is simple. What is the exposure at risk? So it is your outstanding principal plus interest, and in certain case you also consider something which is going to be dispersed in future, unutilized limit. Because what you are doing is, as at today portfolio, you are envisaging what is the default which is going to come ahead, and the exposure will be different as compared to what you are right now. Exposure of 100 rupees to a particular borrower can be 110 or 80 at the end of 12 months from now, or at the end of 24 or 36 months from now. And that's the reason there is a different way of computing the exposure at default. Over and above that, based on certain scenarios like Russia-Ukraine war, pandemic, management has started creating management overlay. So this overlay generally comes only when your model is not able to identify such risk and capture in the PDs, and hence there is a requirement of management overlay. However, there is one more discussion which generally happens with RBI, is that if there is management overlay every quarter, whether your model is correct. Okay, there are certain risk which is coming in, we can still consider there is a management overlay required. But every quarter, if you are doing management overlay for some or other reason, whether your model is equipped, well equipped to give you the correct output. So that is one favorite discussion of RBI with the auditors, with the management, how you deal with the management overlay, because this is something which can be easily used for playing with the numbers. There are three different stages. Stage 1, basically the loans which are paying regularly and you don't see any significant risk, sits under stage 1. Stage 2, this is kind of tricky, because not only based on the DPD, that is any account which is for more than 31 days to 60 days or 90 days will sit in stage 2. So there is a qualitative aspect as well, like a borrower's rating is decreased. You can classify, even if it is making proper payment, you can classify that under stage 2. For stage 3, all the NPAs, which is, so DPD is more than 90 days will sit here. So now take an example, if an account is being classified as an NPA as per IRAC norm, as per RBI requirement, will sit under stage 3. You will apply PD of 1 LGD as per your calculation. What in case that still remain NPA, however the DPD on the reporting date is less than 90, whether it will go in stage 2 or stage 3. Stage 3. Anyone with any other view? Why not stage 1 or stage 2? If the account is NPA DPD 25 days, or account is NPA DPD 81 day or 82 days. But any other account which is there in stage 2 with 80 DPD, not touch 90, is also in default. So this discussion is again a relevant discussion which is happening with RBI and with the management along with the auditors. So ECL model goes with the credit impairment or credit impaired concept and DPD based concept, rather than based on whether it is NPA as per RBI or not. RBI has nowhere in writing clearly given that all the NPAs are required to be classified as an stage 3. However, in certain inspection, they have called out that no, once the account is an NPA, is required to be classified as stage 3. So you may come across NBFCs who is following different practices, classifying NPA as stage 3 or classifying NPAs with DPD less than 90 days even under stage 2. So this is basically for creating the recognizing the interest. So 109 requires that as and when the account becomes account is under stage 3, RBI says account is an NPA, you cannot recognize the. But Ind AS says on stage 3 credit impaired, on the net balance you are required to recognize the interest. So you need to basically do the computation of modified cash flow, that what was my original cash flow, what was the provision, what will be the cash flow, expected interest I can still earn on that net amount, and I need to recognize that. Otherwise you cannot say that the finance or the financials are in compliance with Ind AS. So if you read, I think some financials, they clearly mention that they do that, but they again create 100% provision on those interest income. So Ind AS doesn't work on conservatism. So it is more prudent how to do the accounting. So it is not about conservatism which comes into when it comes Ind AS. IGAP, yes, and IGAP is in line with what RBI says. But when you are saying that the financials are in compliance with Ind AS, you need to comply with each and every requirement of Ind AS, and ECL 109 requires to book the interest income on the net amount, net of your ECL on stage 3. Stage 1, stage 2, anyway you book the interest because they are not yet credit impaired. On credit impaired stage 3, you are required to book the income. Yes. So we opine on this, so we say you book as an interest income and then you create a provision if you believe that it is not. So if you see, that is mainly based on materiality. If a entity like which is coming under upper layer, it will be material amount which you are not booking. For a middle layer or a asset side of 15,000 crore, 10,000 crore, the amount will not be that material. So again, when the opinion comes into picture, the materiality also needs to be taken care of. So that is something which, this is how it has been played while giving an opinion vis-a-vis recording. Or but if you see the top layer entities or the upper layer entities, they were not doing, which was been even called out in, may not be publicly available, but called out in the presentation to the audit committee, that okay, this is what it is, but how it is overall scheme, it is not material and hence not been booked. However, there is a system requirement or development which is going on. Once it is done, they will start booking it. Bank currently is under Indian GAAP. It is not under Ind AS. Pro forma banks are, yes. No, I think, I'm not sure which bank you have discussed, but the banks are doing this. But not only the banks are already preparing their US GAAP under, so they are already there. They are already making the adjustment entry for this interest, even for their US submission, US GAAP submission, as well as for ECL performing. So key, I think we'll skip this slide. One last slide which is important. Dual reporting requirement. So entity which is under Ind AS is required to compute the provision as per RBI requirement and compute the provision as per ECL. If the ECL provision is higher than the RBI requirement, no problem. But if it is lower than the RBI requirement, then you are required to create an impairment reserve. This basically comes when there are small NBFCs which doesn't have their own vintages to see what are the default rates, what can be the PD, who use the CRISIL or any other industry benchmark PDs to identify their provisioning. So whenever there is a shortfall, you are required to create an impairment reserve. This is basically apportionment from your profit. It is not a debit to PNL. However, apportionment from your profit in the reserves. You cannot use this for your capital purpose. You cannot use this for making dividend payment. And if you want to use this in future, you need to obtain RBI permission for utilizing this. There are few NBFCs where they have created this thing. Otherwise, if we see, the provisioning as per ECL is higher in most of the NBFCs. This is just certain challenges, like historical data should be available while computing ECL. Data integrity and validation mechanism from an auditor perspective to check how the data has been used, how the PD has been computed. IT system integration, governance and board oversight. These are, I think, upgrade we discussed, impairment reserve we discussed, upper layer we discussed. Okay, this is all we have already discussed. So this is a conclusion. Scale-based framework, now a 4-tier regulatory structure, high capital requirement, and there are certain upper layer NBFCs addressed because of systemic risk concern. NPA norms and transitions, now everything is harmonized and provisioning is as per ECL. ECL vis-a-vis IRAC requirement, you need to create impairment reserve. Implementation and compliances, so NBFC must strengthen their data management because data is now key for ECL, at least for ECL computation. Board governance and risk management functions. Compliance cost may drive consolidation among small NBFCs, but overall financial benefits will come out of it. So thank you. This was a short presentation from my side covering scale-based regulation. So maybe any question we can take it because I think another speaker is waiting for his lecture. So we can take offline any other questions.